For an instant audit on this, Ron DeVary, founder and CEO of New Capital, is with us. And Ron, the CEO of Alcoa, saying yesterday that he expects the economy to improve slightly this year.
Sure.
Not necessarily a ringing endorsement for where things are headed, but not necessarily negative either.
No, I think it wasn't negative, but it also proves that unless you get the housing market back, you're not going to get really the basic materials to move a whole lot here. And sales are, for example, they were very good in transportation sector, but they were not so good in construction materials. So, and we know that our economy is driven pretty much on the housing, and we expect still the housing to be soft throughout the year, but it's really bounced off the lows.
It's interesting you mentioned the transportation side of Alcoa, because we saw something in the broader market yesterday. According to Dow theory, we saw the transportation sector do well. We saw the industrial sector also do well. And some say that that's a sign, when you see new bull market highs in those sectors, that there's just more good things to come. Is that the camp you're in?
That's true. The transportation is globally driven, whereas things like housing and construction are locally driven. So it's a known fact that we're lagging the rest of the world. For example, the Asia. So the transportation will, the aircraft orders will come, and that sector is actually doing well. And I think there was some specific news in the transportation area, specifically in aerospace, airplanes. It was pointed out by that potentially there are too many players, and they were encouraged to actually have merger and acquisition. Merger and acquisition is always a positive thing for the stock market.
So we have a few big names this week, and
Sure.
As far as earnings go, how are you approaching this earnings season? Well,
I think it's going to be better than obviously last year. I mean, everybody is expecting about a 30% in the S&P components, but you're going to have a lot of misses, like what we saw just with Alcoa, where the specific sectors are not going to be quite caught up.
Let me ask you specifically about the debt markets, where your firm likes to play.
Absolutely.
What opportunities are you seeing there?
To be honest with you, shorting.
Really? And what does that mean about? I mean, what does that mean about the broader markets and the economy? Is there any message there?
Yeah, I think what we need to see is the credit performance continues, especially at the consumer level, to perform very poorly. The corporate credit is really ahead of itself, and partially is because so much money came to the credit markets in order to take advantage of the, let's say, so-called distressed sector. But a lot of people think it's a two-way market going forward, because the high-yield sector, for example, is already in single digit for single B names, which is, we're back to normal for a lot of people. So you need to really pick your spot. You can't just be long, and you would be long and perhaps wrong on credit.
And we're going to have to run, but as far as the shorting side and the long-term side, I mean, what kind of time frames are you operating with?
Yeah, I think the credit market pretty much has run up, because, see, there is not much upside. Once clipping coupon is okay, but you want to really have an upside. And that pretty much will come from picking the good names and shorting the names that are going to be disappointing the market.
The ones with the question marks. All right, Ron. Ron's with us throughout the morning. Thank you very much. We're going to talk a little bit more about the story now with Ron DeVary. He's joining us from New Capital this morning. Ron, how aggressive do you think the president of the United States should be on this issue with currency in China?
I think you have to be soft with them, because they need to deal with their own political situation in China. Manufacturing was hurt when the crisis started, so they're going to take a position that they have to protect their own manufacturing base. On the other hand, the U.S. has got its own political issues that they need to deal with, the jobs that are lost, and the fact that we have our markets open to the Chinese, but Chinese have put up barriers and are also controlling their currency. They're not playing fair.
Well, the Treasury Secretary last week traveling to Beijing, a surprise meeting with the Vice Premier there, and out of that meeting we got headlines that again, according to what happened with this meeting, we weren't there. There seemed to be the insinuation that China would allow its currency to inflate, even just moderately so. So then this is a reversal from that. A little bit. It's tough to know what's going on, which is
more of a rhetoric, because I think everybody believes that they're going to allow the currency regime to shift, whether it's going to be a gradual or a one-time. And they're more worried about to make sure that is not going to disrupt manufacturing.
Well, what kind of timeline do you think they're concerned with?
I think the market actually expecting something happens between now and September. And the market believes that essentially yuan is overvalued by about 40%. That's not going to be that magnitude. We saw a movement of 20% from 05 to 08, and that was the thing that the Chinese allowed to happen.
So let's say they don't do it. What happens then?
I think then we're going to have to take a much tougher stand, because as we stay above, in the double-digit unemployment numbers, the U.S. politicians are going to put pressure on Obama, and Obama has to talk about it. There is a report that was supposed to have come out essentially identifying the Chinese as being currency manipulators.
Right.
And I don't think that's the right tactic, because it's not going to bode well with politicians. Then they put them in a box to say, well, they reacted because the U.S. pressured them. So there's a little bit of a game that you need to play here to make sure that they get to the same conclusion by their own.
Well, and it seems a little bit of a political posturing internally. Absolutely. As well. That report was supposed to be out tax day, April 15th. Now we understand it's going to be delayed. Right. Again, kind of who knows what's going on with that. Do you think we should stand alone, though? I mean, it looks like the United States is really the aggressive one as far as talking to China about their currency, but it's the world markets.
No, I think Asian development banks also have mentioned that there's affecting actually other countries in Asia as well. It's not just by fixing their currency against dollar, it's really affecting the trade within the region as well. So we're not alone on this. I think it's the world against China at this point.
As an investor, though, does this change anything for you as far as what China's premier had to say? If they don't do it, does that change anything for you as a forecast, or is it just a side story?
I think it's sort of a side story, because as a matter of fact, you've got to read between the lines. It's not, at the same time they say we're not going to react to pressure. At the same time, they're also saying that, oh yeah, we are actually going through our own currency regime reform. So, but they're not identifying what that is.
Are there opportunities in the debt market in China?
I think so, very much, actually. I think there's quite a number of hedge funds actually have established units in Hong Kong to be able to take advantage of, the world runs on debt, and therefore, there's going to be more debt issued actually in Asia than it's going to be in the rest of the world, because as they're growing, their demand for capital grows. So I think, but their markets are very unsophisticated at the moment. So as those markets develop, I think there will be more appetite in the fixed income market for those products. But I think we actually at Newell Capital are very much in favor of developing those markets. We have some very active campaigning actually in Korea. Korea debt market is actually still very, very primitive compared to, for example, Japan. So there is quite a number of.
But you like Korea over China?
Korea is Singapore. Well, yeah, both of those, because those markets are opening up. So there is really opportunity to take advantage of those markets. China is still closed, so you have to get into those. The equity markets are a lot more developed in those countries than the debt markets. So you have to take your tack in the individual regions.
Interesting to see where the opportunity is. All right, Ron, back to you in just a little bit. In the meantime, we're going to hand it over.